Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Nina Mishra. She's the editor of Zach's Income Investor Trading Service, and that's the service which buys stocks and ETFs that produce dividends and income and all those fun things. And I know that a lot of people might think that that's a boring part of the stock market. Dividend stocks, who cares about those? But I've always said if you can get, 4%, 5%, or 6% a year just in the dividend yield, you're well on your way to compounding that to basically bigger riches. And I know a lot of people think, oh, you're never going to get, yields that big, and maybe not. But even a small yield like a 2 or 3% can really add up over the years. I know a couple of years ago, I read a really good book on dividends. Well, it wasn't explicitly on dividends, but it had a big chapter on dividends and how the compounding part of it actually works. And it was by Jeremy Siegel. He's a Wharton professor. It was out in 2005, and it was called The Future for Investors. And I do recommend people check out that book, even though it's a little outdated. I wish he would update it because it's been 11 years now. So some of the numbers in it are a little outdated, but he has a whole chapter on how dividends work, and he compares IBM, like starting in 1950, with ExxonMobil, also in 1950. So Exxon was kind of the old, mainstream. It paid the dividend. It was slow growth, like your grandpa owned it. And IBM was at the time like the Facebook or the Amazon or, the super hot growth computer technology company. It didn't pay a dividend, and you would think to get the big returns, you need to be in the high growth IBM versus the slower growth paid dividend Exxon. But he lays out this whole chart that shows over the next 40 years, even though IBM eventually paid its own dividends later on, the best returns were actually in Exxon because that dividend, even if it's just 2 or 3, it just keeps adding on there. And in down markets, you're still getting it and you're buying more shares if you're reinvesting it. So that's what I like about dividends, is the kind of this hidden secret with them, that if you stay in there and you reinvest it and you're getting that 3 or 4 or 5%, it really adds up.
That's right.
So today we're going to talk about some more hidden gem type of dividend payers, because everybody does know about the Exxons of the world, which they are paying bigger dividends right now, real nice juicy dividends. But there's also some, mid or small cap companies that are paying really nice yields right now. I've been surprised. I've been looking around and I'm is that for real? Can I really get that in companies that are, high Zacks rank, and that a lot of them have good growth potential as well. So they're not like the companies like my grandmother or whoever would be investing in. So you brought a couple really interesting ones, Nina. Let's start off with the first one that you sent me. That was Apple Hospitality. Now it has this ticker APLE, and I have a feeling a lot of people at first I was like, why is she sending Apple? And I'm like, wait, no, it's not that one. It's a different one. And I'm sure some people accidentally put this ticker in all the time into, various, stock brokerage accounts or, Yahoo Finance or whatever, and find themselves looking at Apple Hospitality, which is a REIT. And they're like, no, this isn't the one I want. But now here we are talking about it. It's maybe it is the one you want.
Yes. So I totally agree with you that dividends, they are an important part of total income. In fact, historically, dividends constituted almost 40% of total income, but they don't get the love that they deserve.
No.
We all focus so much on earnings and EPS, and while earnings can be somewhat managed by the management, dividends are actually cash in your pocket, which you can reinvest, and your returns can grow year to year. So let's go back to our picks. The first one, it's a hospitality REIT. The ticker, as you said, is Apple and APLE, sorry.
Yeah.
And REITs, they have been in favor. Investors have liked them because of their high dividend yields.
Right. That's like an
obviously.
area that if you are looking for dividends, you
Yes.
certainly should go and look at because it's the
Yes.
real estate and they pay a part what the income that they're getting in goes out to you.
Yes, because they have to distribute 90% of their income. And especially in this low interest rate environment, and when the economy is recovering, these REITs have a lot of potential. So this is a hospitality REIT.
So they own hotels, right?
They own hotels. It resulted from 2014 merger of 3 non-traded Apple REITs, and its share began trading in 2015. They own a portfolio of upscale select service hotels across Hilton and Marriott brands, mostly located in urban and high-end suburban and developing markets in 32 states. Their current portfolio is 179 hotels with more than almost 23,000 guest rooms. So if you look at the stock, it's a Zacks rank 1 strong buy stock as of now.
And what's that dividend yield? It's pretty juicy.
It's
6.5, I saw.
6.47%.
Yeah.
Very, very interesting. And in fact, if you look at the detailed estimates, they have seen nice increase in estimates after the first quarter results. So that shows that there is good potential for earnings growth as well going forward. And as you said, that investors should look at Zacks rank as well in addition to the dividend yield, because sometimes a high dividend yield can mean a low quality stock.
Right. It's kind of like a fake out thing too.
Yes.
I look at some of them and I'm like, 9%. And then I go and I look at their earnings and I'm like, wait, they're barely earning anything. How are they even paying that out?
Yeah.
And some don't pay out every quarter. Like they kind of decide that quarter whether or not they're going to do it. So it's not a guaranteed dividend kind of thing, even though no dividend is really guaranteed. But some, again, like an Apple or an Exxon, pretty much you're getting what you're getting every quarter.
Yeah, because cutting dividend is a very bad news. That shows there is some serious problem with the company. So if they have to reduce their payouts to investors, to shareholders, they might stop their share buyback plan. But dividend cuts are usually unusual, especially in case of better quality companies.
Okay, these guys, Apple Hospitality, they have a market cap of $3.2 billion, so they're a mid cap.
Yes, they're a mid cap. And my second pick was a staffing company.
Yeah, this one, I actually noticed it not that long ago, probably because it is a Zacks number 1. So I was looking around at those, and I was looking for small caps, and these guys only have a market cap of $150 million. So they're real small.
Yes.
But I was like shocked to see what their dividend yield is, because it's around 6.5% too.
Exactly. Very, very juicy.
And I was like, how could that be? Because usually small cap companies
don't pay out that
much. They don't pay out at all usually. And if they do, it's like some paltry sum where you get like $1 every quarter or something like that, for your 1,000 shares or something. But this is like real dividend. And I even looked kind of to see, could they afford it? Is this like some kind of fake out one like we were just talking about? But it doesn't appear to be.
Yeah, in fact, I looked at one of their investor presentations, and I saw that they have seen very nice increase in revenue and EBITDA over the years, 41.5% growth in revenue and 49.8% growth in EBITDA over 2012, over the last about 3-4 years. So that's an excellent growth, consistent growth rate. So I think they should be able to maintain their payout as well.
Yeah, they do a lot of temporary staffing, I saw, and they look like they're big in Texas.
Yes, they're Texas-based, and they have they provide temporary staffing services to a diverse set of industries.
Yeah.
And I think if we ignore the jobs report for the month of May, which was probably an aberration, then the job growth labor market has continued to strengthen. But there are still many companies who prefer to hire temp workers because they are not too sure about the macroeconomic and political situation.
Yeah.
So because of all these political uncertainties uncertainties, they prefer temporary workers. So that's good.
Good for these guys.
Good for these
Okay,
guys.
their ticker is BGSF. I don't think we mentioned that.
Yes, and they have a unique distinction of A for value, A for growth, and A for momentum. All A for all three style metrics. That's not very usual.
No, with the number one rank. So they're
With
like
the
basically
number.
the top of all categories.
Yes.
Wow. Okay. Your third one I thought was kind of interesting because none of our picks, I'll reveal this now ahead of time, none of our picks are actually banks, which is also interesting because historically that's where I would have gone for dividends. You know, you bought like the Citibanks or, you know, Bank of America to get the 3 or 4% yield because again, like my grandma would have bought them, like the banks are safe and all of that. But now these picks, other than this one we're about to talk about, you know, aren't really financial related.
So they are an investment management firm.
Okay.
And
Manning and Napier.
Manning and Napier. The ticker is MN, and they also have a diversified client base, mostly high net worth individuals, but also institutions, including 401k plans and pension plans. So they offer both equity and fixed income portfolio, as well as blended asset portfolio, which include both stocks and bonds, and they do this bottom up fundamental research and then invest in all caps, all countries, all styles and all sectors for best total return. Now this for this company, they had seen some asset outflows over the past few quarters.
That's what you have to watch for.
So then I saw that the investment performance was really strong in the fourth quarter and then in the first quarter, and that should slow down the asset, outflows, cash outflows, and that is why the stock has really started doing well this year. So I think this is more of a turnaround story.
Okay. They're also real small cap, 132 million market
Yes.
cap. But what's that dividend yield?
7.27%.
Wow, 7.2.
Yeah. And
When do you get that? Like that's almost like a total return for a year.
Yes, exactly.
Wow.
And they have a value score of A, trading at a forward PE is just 11.05%, and a growth score of B, resulting in a VGM score of A. So those things also look quite good, and it should be good for the.
I looked up this one to see how long they've been paying the dividend since it's so juicy. And they have been paying it since 2012. So it's been, several years now of consistently paying that out. So just an FYI to everyone out there wondering if, how for sure this one is.
Yeah.
Okay. So that one's really interesting. I didn't have as good a juicy ones. Well, I guess I have one that's kind of juicy. But my picks were, I picked a kind of mid cap. Well, I guess they're a larger small cap. H&E Equipment Services. Their ticker is HEES, and they are one of the big equipment services that does rentals and sales. They have like 4 different categories, though, so they're maybe a little different than some of their competitors, but they operate in like high lift or aerial platform equipment, cranes, earth moving equipment, and industrial lift trucks. So obviously some of that might be energy related, and the stock did get hit on, fears over the last year of a downturn in the energy market, and also mining, and, they're heavy in construction, obviously. So it depends on what areas they're in. But, they've paid the dividend since 2014, and they've been paying it every quarter, even last year with all the problems in various industries. So I like that. The dividend yield is 5.7%. So that's pretty juicy up there. And they're a number 2. They're not as cheap as some of these other stocks we were just talking about in terms of a PE, but they're at 17 times, which I don't consider to be too expensive here, especially when you're getting that dividend. Their earnings, they're kind of a turnaround too because of the slowdown in various of these industries. So I consider them to be kind of, a rebound kind of play. But I like the construction area and anything related to that now.
Definitely a bright area.
I feel like that's still doing well. And their ticker again was HEES. I think I mentioned that, but just in case no one caught that. And then another one that I like a lot, I actually own this one in my own portfolio now because I liked it so much, is called New Media, and the ticker is NEWM. And they are in publishing, which I never would have thought I would have bought because they actually literally do magazines, newspapers. They do digital and online, everything associated with that, because all of these newspapers now have websites and all of that. But this is an area that, is like, again, my grandma would have bought in. It used to be newspapers were like the place to be. And that's why Warren Buffett always bought them, because you had to have you had the classified ads, and everybody had to put something in there at some point, and everybody was advertising, and there was like these like monopoly markets. But then online came, nobody needed to read their local paper as much, and the whole industry kind of changed. But these guys are big into acquisitions. They're buying a lot of the regional newspapers. They own like over 100 newspapers now, I think. But so they'll buy like the Columbus Dispatch, which is actually quite a major newspaper in Ohio that was family owned for years. They bought that out big, several million people in their region are reading that. So they turn around these newspapers and, try to make them more profitable. They just bought the Erie, which is a daily newspaper in Erie, Pennsylvania. But some people might be familiar with them, but not really know it was them because they actually own the Las Vegas Review-Journal that, a couple months ago, Sheldon Adelson bought it for this huge premium. He just basically went in there's like, I want this newspaper and here's what I'm willing to pay. So like, okay. And they sold it for a lot of extra cash. And so that allows them to go out and continue their strategy of acquiring all these other newspapers and digital and all these other media kind of companies. They also have like an interesting marketing company that partners with businesses with the Google AdWords to like monopolize or figure out how to, get the most out of the Google portion. And that actually saw revenues up really big last quarter, up 71% to about 10 million. So those are areas you need to watch with this company. They're also a small cap, 775 million. But their dividend yield is 7.5%.
Wow.
So I was like, at first I'm like, no, that can't be true either. Like, who's paying that? But they definitely, are paying it out. And a lot of the insiders actually on management have been buying shares because, you're going to get 7.5%. Like, if I can get that, I'm liking it. So PE is not too bad on this one, 13.5 or so. So that's another one to keep in mind. Again, the ticker is
definitely very interesting.
yeah, NEWM is the ticker. So yeah, some of these are just like the individual stocks you can go out there and look around at. But I know some people get nervous because, these are all small caps, except one mid cap in there. You might not be as familiar with their businesses. You don't know for sure if they're going to pay out the dividend. You don't want to get stuck in something. So another option would be to use ETFs to try to tap in. And I know one of my favorites that I've looked at over the years is the S&P 500 Dividend Aristocrats. And that one with the ticker SDY, they look at companies that have been raising their dividends for the last 25 years. So this is something my grandma would like this, but I like it too. And these are the Exxons of the world. These are going to be big cap companies, who are very consistent and obviously able to raise their dividend over that amount of time. I saw that it's yielding 2.4% right now.
Yeah, that's definitely a very interesting ETF. It has done pretty well this year. In fact, among dividend ETFs, there are so many options. You can look at dividend aristocrat ETFs, which are like mostly high quality companies which have been increasing dividends. And among dividend aristocrats, the one which you mentioned, SDY, there's some other options like VIG, which is Vanguard Dividend Appreciation ETFs. It is very cheap, just 9 basis points in expense ratio. Yield is low, about 2.2%. But again, these are companies which have been consistently growing their dividends for more than 10 years, very high quality companies. So if you want to stay in very safe zone, then this is one ETF which you could look at. There is another one, Dividend Aristocrat ETFs. The ticker is NOBL. And that also follows companies which have have been growing their dividends, increasing their dividends for at least 25 years. So those are a couple options. Then, of course, there are other options if you want to go to the mid-cap space. There were,
I didn't even know there were ones for the mid caps.
yeah, there are some for mid-caps as well. So there was one you were talking about.
Yeah.
And if you want to look at small-cap ETFs, there are some ETFs which provide exposure
Really?
to smaller caps, dividend-paying companies. So
I didn't think there would be any for small because they might not have do they actually look at the track record, or is it just they pay a dividend, so we'll put them in here? What do you get with those? Because I know on the mid-cap dividend aristocrats, the one I'm thinking of has the ticker REGL. That is one where they've raised dividends each quarter for 15 years. So you still have to have a track record on that one to qualify. But the small guys, I'm just wondering if they just throw that out the window or if they can find enough,
they do look
companies.
at dividend record also.
Okay.
But they, of course, being smaller cap companies, you cannot get that kind of 25
No.
years or 10 years of
yeah.
record. In fact, I'm looking at the most popular one here. I couldn't open the page. Give me 1 minute. VBR is one of the most popular. It's Vanguard Dividend ETF, and for some reason.
VBR?
Mm-hmm.
And that one, I wonder if it's okay, if you can do it for 5 years, we'll include you in there. It's like, woohoo, 5 years. Because it is harder for the small guys to consistently do it. Although I am always surprised. There's some that have been around we've been in business since 1970, but they just are smaller. They're not going to be, a $5 billion company ever.
Exactly.
But they, have this great consistent cash flow and they're able to pay it out over all those years, just doing their things in the heartland of America.
Yeah, I don't see. They look at the track record for many years. Probably that's not a possibility in case of smaller caps.
I would think maybe, they might throw that out. So if you want, I feel like you need to stay with the bigger caps if you want a track record one of these ETFs. But if you're just looking for yield, there are other ways to do it. But I do encourage people who are thinking about the individual stocks to definitely check out, there's only so much you can look into, because if they're going to quit paying it, they're going to quit paying it. But, check out what they're actually earning. Do they make enough to pay that dividend? I mean, that sounds like basic, but you do need to look at it. I've looked at it, and sometimes I've been like, they're actually paying more than they're bringing in. So are they getting that from a loan or something? Where's the money coming from? Because this is money in your pocket. So the business has to generate this. So always look at that. And then I do go back and look at the historical dividends, I was mentioning on some of these, how long they've paid it and whether or not they've increased it or cut it in those years that they've paid it. And you can find that information on Yahoo Finance. On the quote page, you can go to historical data link on there, and you can find out what they've done with the dividends since they started trading. And I always feel like that's a good indication of how serious they are about paying the dividend. So definitely, people should check there as well. But dividends, this is the place to be right now with the 10-year so low.
And you can get 4-5% yield with these dividend stocks, or some of the ETFs you can get 3%, 4% very easily. Whereas from a 10-year bond, you hardly get 1.6, 1.7%.
I know, it's awful.
And it's not that bond yield are going to increase anytime, because in other parts of the world, they are having negative.
I know, it's even worse.
So U.S. Government bonds are still so popular, so the yields are not going to increase anytime. So stocks are the place to be in if you're looking for dividends. And it's if you're worried about risk, maybe go in for an ETF or just stay diversified, have a portfolio of high quality stocks, small cap, large cap, mid caps, then that will keep you safe.
Yeah. Okay. Good advice. If you want to read more about what Nina thinks about ETFs and just dividends and everything else, you can definitely check out our articles on Zacks.com. There's some really good dividend ETF articles. I'll try to link to at least one or two of them on this podcast, because some of those give good information as well. And then obviously you can check out all of our podcasts on Zacks.com, or we're also on SoundCloud and, of course, iTunes. I think a few other places you can find us as well. So definitely look around for us there because you'll see some of our other good discussions. Nina and I were just chatting about India before we started this podcast because we've had some good discussions about India before. So I think we will probably have to have an update on that because a lot's going on over there. So definitely check out that one. But great information on all these sites, and we'll see you again next time.